Are banks around the world entering a liquidity crisis? Hello, ladies and gentlemen, and welcome back. Today, we discuss the impending cash issues that many regional banks around the world are starting to show. We also talk about this one, Silicon Valley banks, down 60% in day trade, down a further 20% in after hours. What's going on? Let's talk about that and everything else to do with stocks, commodities, and cryptos right now. Well, welcome back, everybody, to the Daily Show where we discuss news, macro, lead indicators, and the hottest charts and key levels that you need to be watching. We'll begin here with, of course, the big storyline. Basically, just hours after the market closed, we've seen reports now of funds advising clients to do the old-fashioned bank run, pull their money from the bank and get out while the getting is good. This could also create a bit of financial instability over the next couple of days because, as we know, this has happened before with the Greek crisis and other things. And although we're not sure on how bad it really is yet, the markets weren't pulling any punches when they sold financials across the board, which we'll be looking at. On top of all of this news, we have one of the biggest economic bits of information, which is, of course, the non-farm payrolls, the jobs numbers. We saw in the previous video I put out that JP Morgan, and I agree with this statement, says that bad economic data is bad and that good economic data could be even worse. If we see hot jobs numbers, what does that mean? The Federal Reserve has to act, and overall, they're going to have to push yields higher. We're starting to see the cracks show in the financial system as of the last 24 hours. So what's going on? Well, I think this probably represents really what's going on with the banks. So small bank reserves are as low as they are going to go. They're basically drying up the source of funding for loans. Look at the difference. The financial stability of big banks is actually not too bad. The financial stability of these regional banks looks very sick. And of course, we know this could be systemic. We don't have enough information just yet to find out, but as we know, markets are moving. This is what actually happened. I shared this over on Twitter. Follow at FX Evolution if you're interested. Links in the description down below. And as soon as the news hit about this bank having an insolvency crisis, potentially starting to do a capital raise, not only were the bank's bonds thrashed, the stock was thrashed, but then the market itself just fell off. There was no buying going on. It was one of those classic sell-offs into the close and then wait and see for the news. We're at now a critical support, which we'll talk about later on today's video. So what sectors were doing poorly and what was doing well? Well, it was realistically everything getting sold, but in particular, financials down 4% and regional banks down 8% plus. Now, we did see some of my favorite sectors for defensives holding up: utilities, staples, healthcare, and gold. They tend to do better during these periods of time, and we had been spotting this already in action in some ways, maybe loose lips about this issue with the utility sector and our interest in it over the last week and a half. Now, over a five-day rolling average, only two sectors are beating it, which is solar and technology, and they're barely beating it. But notice that things like staples and healthcare are starting to come up the ranks while others are down pretty heavily. So what is happening with this market? Well, the market became complacent, and we know this because it's been following the no recession path. Is this crisis within banks, which sounds very similar to, of course, what we all know as storylines, when it's in the financial system, it's not good because that usually means there's some systemic issue. Are we starting to see the cracks showing for recession? Well, the markets obviously are repricing. We talked about how JP Morgan said that the market was overvalued by positive 5%. So basically it needed to go down around that period. We don't know again how bad this is yet, but what we do know is that generally speaking, when certain key things happen, there are worse things on the horizon at some point in the future. Now, timing's everything, so that's going to be the most important aspect here. And we don't want to panic. We need to be looking at the price action and learning what the positionals are telling us, because the weekly closes this week are going to be so important for crypto stocks and commodities. Make sure to subscribe if you're interested in this data, by the way, because we'll be coming at you with a big video on the weekend. So let's talk about forward EPS growth. That turned negative a few weeks ago. That was kind of a sign that maybe there's going to be worse to come. And generally speaking, this means that just basically compression overall of valuations. We also know that the Federal Reserve has been kind of saying, we'll do whatever it takes, we'll push it as hard as we have to, and we will push rates until we combat inflation. The market didn't believe them. It started to believe them about 2-3 weeks ago, And now in the last 24 hours, since we've seen this financial issue with throughout the banks, we actually had a big change in the forward yields. We went from a higher terminal rate, being the orange line, to this blue line here, to a lower terminal rate and more cuts on the horizon. So that might be, good for some quality assets, but what it's showing you is that the bonds market is starting to impact and starting to say, well, wait a second, I think you've already broken something. Maybe you're going to have to go a little bit softer because something is going on here that we don't know how bad it is just yet. ERP is also something I think that we should all have on our watch list over time. Morgan Stanley obviously came out with this one a little while ago. This is from Mike Wilson. I picked it up. I totally agree with it. If we go into a recession, we tend to see equity risk premiums pricing realistically happen. And what this means is that we usually see some kind of risk being allocated to riskier assets. At the moment, we haven't seen that. We're over here, and we've actually gotten a little bit worse. We're over here realistically in terms of how much risk for the reward people were considering. I was talking to a bond manager recently, and they said, look, unless you're making over 5% above cash rate, it may not be the worth the risk in a lot of asset prices. And I think this is also what's happening across these smaller banks. People are pulling money and chucking it into other assets that maybe weren't so attractive a little while ago, treasuries, corporate bonds, and that's drying up some of the liquidity out there as well from the bank side of the book. Let's look now at what's going on with the Fed, and we know that the Fed liquidity has been draining for a while. They're obviously in tapering. We also know that during the month of January, we saw Fed and other central banks around the world have a little bit more of an injection. Did they know something? Were they trying to inject to maybe support part of the economy? I don't know, but that's since dwindled, especially around the probably early weeks of Feb when we were talking about it. Central bank liquidity has dwindled recently. It's gotten worse, and we don't see tapering stopping anytime soon. Here's a chart we share all the time. The Fed always breaks something when they raise rates. Could this be the beginning of the break? Regional banks, I always think it's zombie companies. Basically, lending to businesses that make no money is eventually going to become a problem. The Federal Reserve has always been there to backstop it. This time around, they can't be there just yet because they've got to deal with inflation. So again, it could cause some concerns in the market, some systemic issues. We'll find out. But at least we know the stats are when the Fed raises rates at a pace like they've done before, or they've done right now, they break something. When the Fed also pivots, we know that usually markets tend to go down more. Now, I'm not saying this is the great financial crisis or a dot-com bubble. I don't think we know that. And I'm generally optimistic on stocks, okay? Yes, things are terrifying right now. I'm sure everyone's freaking out. And obviously, whenever you have a bank issue, no one likes it. But what you've got to do is you've got to remember that as long as the real estate market can kind of prop itself as much as possible, and I still think real estate's coming down further throughout 2023 due to rates, as long as that debt doesn't become systemic, in general, we'll be okay. Now, if you see systemic issues in the property market, yeah, we can go hide under a desk for a little while. But at the moment, it's not just quite there yet. So when the Fed pivots, we tend to see further drops in markets. And of course, we're not even at a Fed pivot yet. So just remember that in the future. Whatever the price action is now, which could be up, down, and all around kangaroo, in the future, when it pivots, it tends to fall further. Smart money versus dumb money has been pricing in neutrality recently. Now it's probably going to make a switch. I'll update this over on our Twitter so you get the updated chart after the non-farm payrolls day. I think that'll be an important one. But as you can see here, neutrality into a fairly neutral price. Basically 4,000 on the markets is super neutral. So let's get into the big storyline, and it has to be with this stock. Down 60% in trade, down at the point when I was seeing it post, it was like down 24%. It might be even worse. I mean, when you have other people putting out notes, get your money out of the bank now, put a run on it, bail, 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 that's never a good sign. And it put pressure on everything under the financial markets. We also saw one of the banks that we've been looking at for a little while, which is Credit Suisse. People have forgotten about this one. This thing is sitting at $2.77. To put this in perspective, I mean, this is Credit Suisse, by the way. Look at where it is in comparison to the global financial crisis. And then you'll really see how bad it looks. Look at the volume inside of it as well. There's so much transactions going on here. I don't know. I wouldn't buy this thing. It's toxic in my opinion. But anyway, Credit Suisse 277. The issue for the American banks was the regional ones, though. 3 standard deviation move in one session, -8% across the board. It absolutely clean broke everything that was support before. You're underneath this level as well. At this stage, could it be going for a gap fill 44? The financial system clearly here starting to get knocked off. Usually that's a bad sign for the rest of the stocks. Now, the big financials, which we know have better, they probably will benefit out of this. Let's just look at this as a serious situation. When the dust settles on this situation, who wins? Generally speaking, the better capitalized banks. Just like in the global financial crisis, they go in there and they get their little caterpillar hands out and they buy everything cheap. They buy it for under book value and they end up being winners. But at this stage, we know that they are sitting on a precarious situation. Down 4% on the day. Certainly the discussion is around financials right now. And you can see the volume spike out of control, very, very high. And I would suspect this pressure keeps going. Basically, it could close underneath here. And if it does, then we have to look at the weekly, the monthly charts and start to say, are financials tipping? Does this bring the rest of the market with it? Let's have a look at yields. Now, I've got the US 2-year versus 10-year yield inversion up. I expect this to start to drop at some point soon. And what that really is going to show us is that we're hitting those kind of peaking rates for the US 2-year. If you have a look over at the US 2-year, it's spiked into a zone that I think anything here is kind of starting to hit what we call terminal rates. And you can see the US 2-year really hasn't made it past 5.2 for a long time. This was back in 2006 before the global financial crisis. What a funny area it ends up getting to. So we're in this zone. This is where I seem to think that 2 years probably start to struggle. If we look at US 10 years, which is obviously dictated to by the market, it's falling. If you want to know if something's getting really sick, then you'll see the US 10-year fall more than the 2-year. That means even more inversion. But in general, the bonds market sniffed this out a while ago, and everyone's just been ignoring that the bonds market doesn't like the current prices, and it's still pricing in a recession at some point in the US over the next 12 months. We're about 12 months into when it first called, and do remember that on average, it takes between 12 and 24 months for the bonds market to be proven correct when it has over 50% of all the yield inversions. We saw that 12 months ago, pretty much in March. So now we're on a line of anywhere in this next 12 months, we'll get some kind of recession call, generally speaking, and then go from there. Now, was the US dollar safe? No, not even the US dollar was safe. It left behind a massive gap, which I think is interesting. And I could see the US dollar still, rise into this level. But it was just kind of like a sell-off across the board. Most asset classes struggled and only really treasuries held up, which has been one of our favorites here recently. Have we turned to a downside trade on dollar? Not yet. I mean, you'll have to get underneath this level here, which we know is where strong buying occurs, 104.15. We've found ourselves in kind of like a 61.8 retracement of this high. We have a gap here. Non-farm payrolls could quite easily come and fill that gap. So take a look at this gap on the futures, DX1. You can see where the gap is. It could easily do something like this. So just be very, very careful of this non-farms. It's going to be explosive and big moves are coming. We put it in our title in the previous one. I truly thought that we'd see quite a lot of volume volatility, and we have gold sitting right in the middle of the zone. It's completely neutral. Generally, you'll see a market pushing either a bearish or bullish narrative before non-farm payrolls, so they'll usually be sitting on an extreme level. But like the US dollar, all the currencies are sitting in between. They're super confused. The stock market's pretty sure it's sitting on its lows like I'm going to get trashed. But yeah, we're not seeing that realistically in the gold side at this stage. If yields like the US 2-year and 3 months start to drop, and we also see the 10-year start to drop, expect gold to be a very interesting play. So I'm super interested in the weekly close here. I am a fan of gold. I do think that gold will end up getting to $3,000 an ounce over the next 5 years. Yeah, that's a long time, but I am bullish on it. That's still a big capital appreciation. Remember, it's like 50% up, but it all takes yields coming down. We need to see interest rates coming down. What about the Widowmaker natural gas? It continues its decline. It's getting closer to a level we've discussed. We do think that it's probably starting to bottom off. The only thing is it like this, which is a more traditional bottom, or is it going to turn into a Wyckoff? Be careful of the Widowmaker. There are all sorts of issues with this one. If you're not prepared to go into something that could lose 30% of its value in one session, then you can't be involved in natural gas. Also, exchange traded funds, look up fact sheet because you're going to actually need to know what you're buying there. What about Tesla? Well, this one I would imprint in your brain. I put it on Twitter and I said, look, if you've been looking at Tesla, watch what's happening here. Feel the emotion of what happened when it rallied up and feel the emotion of what's happening right now, because really this is a classic sell-off and it's super nasty and it's super Wall Street. You know, that's what they love doing. So we saw that higher high, which sucked people into the rally, thinking that they would get it all the way to 230 and they'd get out. Of course, they've been left potentially holding the bag. Hopefully that's not you. We saw the island reversal, the stupid investor day thing, and I'll call it stupid because the market rallied so much into it. You know, it was only going to sell off during that type of time. It was one of those buy the rumor, sell the fact. And now Tesla is moving down pretty heavily. I wouldn't be surprised at all to see the next session hit somewhere in those 165s. And then there's even a chance that Tesla, well, actually, I've said it quite a few times, will come back to that gap fill of 61.8, which is the 150s. Be very careful here. When you get a market rallying like this, it tends to come back down. That doesn't mean the buyers won't recommit here. Obviously, the news is starting to turn really negative and bad in the last 24 hours. But again, you know, what Warren Buffett always claims is, you know, buy when others are fearful. You just have to be able to see through it and say, well, is it going to keep going? Is there more capitulation to have? Is it even cheap? What's your plan? Is it trade vesting? Is it investing? Is it trading? Traders probably don't want to just pull the trigger. Investors may want to say, well, okay, I've found the price that I want to hold it for 10 years. If that's true, then, you know, stick by whatever you've made your decision on. Let's look at Tesla. We were not really too interested in this week's options expiration, but we are interested in the next week's one. The poor 200 calls, they're probably going to lose. Could it go lower? Yeah, based on the options chain, it certainly could. Max pain sits at 183 next week. We're obviously underneath that now at the time of trade. 2.15 million units, so a bit at stake. But a week's a long time. We could easily go down and then straight back up again, and it would still be in the parameters of what a normal market could do around these options expirations. Remember, it's a tool. It's like 5 to 10% of the reason. Use your technical analysis as much as possible. Here's Apple. Let's have a look at the weekly here. Another rejection week off the expected weekly options highs. Another sell-off of that was what ended up happening. I was looking for potentially a swipe of the high this week. Didn't quite get as high as I'd hope it would. If it did, then that would have been sweet sell. But yeah, look at this. 2 big red days, 2 smallish green days. Apple's a strong stock, but the expected weekly options high was too much for it, at least until now. I think the stock market will be more interesting than that stock, though, in terms of predicting some key levels in the future. We'll look at that very, very soon. Nvidia, yeah, it's just floating around. The word AI is pretty strong. It was down 3% on the session. We're still in that gap up kind of consolidation. I'm looking for a day where it comes out getting flogged. And unless that happens and it gaps down and starts getting hit pretty hard, I don't want to call a top on this stock. It's trading in AI. It's trading completely disconnected from the other market dynamics, and you've just got to be careful of it. A lot of people say, well, semiconductors lead us out of rallies or lead us out of crashes. That's true. Semiconductors are a great sector. However, I'm not sure if that's what we're seeing. Remember, the Fed breaks something, we might be starting to see the break occurring. XLU, probably my favorite sector at the moment, just because it tends to hold a little bit better in bad times. And it also tends to do okay over this period. We saw that big resurgence of it. It held very well over the last 24 hours in consideration of the other sectors. I want to see it break through 66.81. Can it go up when others go down? Depends on rotation from the street, but generally it should hold better than the others. We'll find out whether it keeps doing that, and it's doing okay at this stage. Here's the Australian stock market. Now, it's open at this time, so you can actually see the damage that's getting done to the market. It's down 2% here from the Australian market, and we have better capitalized banks. So in general, although Australia is basically energy, materials, or metals, and banks, the banks are down, but they are better capitalized. They're usually pretty safe, especially the big ones. If we go over to the 61.8 fib, this is an area that I thought might see a bounce. So that's interesting. It's coming down here before non-farm payrolls. Still targeting in at that 7,100. And if copper starts to fail, which will load up right now. So remember, copper is something I've been looking heavily at. I want to see copper start to weaken, go underneath 393 here. Then that shows us the world economy is pretty sick. Now we're seeing financial struggle. We haven't seen copper, which tends to actually fall off, come with it. And I have a guess that this is China's stimulus holding this up, and maybe copper's not the best read. I've been on the record talking smack on copper up here. I've obviously been, pretty negative on it, along with my negative kind of opinions on oil for quite some time now. But this one in particular has been, a bit more resilient than I'd hoped. And I would like to see copper under 393. Will non-farms be able to push it through? Let's move over now to the triple Qs, and it all comes down to this monthly candle. This is actually doing the classic kind of sell-off thing. Basically, you get that nice kind of closes all over the top of each other. You get that rally through, it sells off, creates a big shooting star style candle, gets a rally to a 61.8, and then starts to drop. So the Qs don't look great on the monthly. The weekly doesn't look fantastic either. All the main gaps got filled here. And then the daily itself is on the expected weekly options low right now. If we move over to the SPX though, this is the market you really should be looking at. Now, a lot of people are going to have something like this drawn. They're going to draw the trend line that was the big thing of 2022, and they're going to say, still holding bullish sentiment. Theoretically, yes. The facts are we moved and closed below the 200 daily moving average. That's a pretty big deal. Often people see that as trend up or trend down. We rallied to the 61.8 fib, which also filled one of the gaps here, which we totally expected. We thought we'd get a little bit more of a rally here to do something like this before non-farms, so we'd be sitting maybe in the middle or the top. But as it turns out, non-farm payrolls is pushing the low narrative. So we usually thought we'd either be at the extreme high or the extreme low. In this case, we're finding extreme low with the fundamental news that's kind of blown it out of the water park. So if we close this weekly this low, what does that open? If we get underneath 3,900 for the weekly close, which at the time of recording is quite possible, then we may be going for all of these gaps. Unfilled gaps at 3,750, 3,800s, and a most traded zone through this structuring of 3,820. Remember, if we look at central bank liquidity, it has dropped in recent weeks. That is, there's not been as much support of the market. So maybe, JP Morgan's correct in its modelings of forward fund future, rates. It says -5 from that level. Well, if we took 5 off this and we got where it should be going, 5% would push us right back into these lows. So that's where they deemed, as of the last 24 hours, for price to be fair value. Of course, a recession probably would drop it further, but at this point, we're focused on the key levels. And if we always said if we broke past this 41.20, then we'd be going, all the way up to 4,300. It still was a possibility, but as of the last 24 hours, that seems to be out of the door for now. Let's move over to the futures market action. You can see the pressure getting put on this bottom end. Coming into something like non-farm payrolls, one of the levels I like is the structure that's here. So remember, non-farm payrolls does tend to, and it may not this time, but does tend to push the wrong narrative first. So if the narrative is bearish, it could actually go like this, push up 39, kind of 80, and then sell off from 39.80 to go towards our confluence zones, which sit at that 38.30, 38.40. That's a big zone. Now, the other option is that the market dumps straight into here and then find some buyers. Now, if you look at structure, you'll kind of see why I've got that. It's the middle of all of this build. So in essence, it's kind of like where Wall Street was probably on average buying. So I like the idea of either non-farms pushing the narrative up here and then finding some bears, or pushing the narrative down here and finding some temporary relief. Both of those are interesting plays coming into the non-farm payrolls numbers. We know that we're at a critical level. We know that if we break this down and we close the weeklies lower, that's probably going to get Wall Street positioning a decent amount of shorts. Watch the weekend video if that occurs. But we also know that we've got 3.4 million options expiring next week, and there's a lot of puts here. Now, could those puts be owned by the street? Absolutely. It's third week OPEX. It's the quad witching event. It's going to be a blockbuster, and I expect a lot of options flow coming through over the next week. You've got to be watching it very closely. We'll resume that on the weekend. What about the crypto markets? Well, they got obliterated back through 20,000 20,265. We had a watch reaction at 21.45. Absolutely no reaction, shredded it straight through. Remember, when you have these watch reaction levels, which we put up before, and this is one that we put before it happened, if you get the reaction, cool, it shows a critical zone. I put them there for a reason. I call them critical levels. This white line is also an interesting fight zone for Bitcoin. It's the last little block over here before potentially getting obliterated all the way back down into the 17,000s, because remember, this was a fast move. So again, if it rallies and starts dropping through here and closes weeklies, where could we be going to? This would equal a 3,800, let's say, on the S&P 500. Now, I haven't lost hope of getting one of the things I've talked about a lot on crypto, which is 11,500 to 9,500. I'll talk about Bitcoin on the weekends once we know more about non-farm payrolls. But at this point, it's at a critical zone. It's trying to hold its best. And you'll see here the 2-hour just closed below. So look, rally is probably going to be met by sell demand at this stage. For the news ahead, it's all about non-farms. 1 hour before the market opens, 8:30 a.m. New York time, we get the jobs numbers. Hot or not hot, I mean, technically all the news is bad, as JP Morgan said, and I agree with them. But we'll see the reactions. And as I say, patience, react, don't predict. Try to find the reactions, look at the key levels, have your activation in your own systems, and then hopefully you can find what they're really moving the markets to. Thanks so much for watching. If you enjoyed today's content, remember to subscribe, smash that like button. There's a giveaway for a bunch of free courses if you're interested in March. So just click the links down below. You'll see it in the pinned message and the description. And remember, follow us on the socials also down there. Thanks so much, guys. Thank you for being supportive of the channel and all of our other socials. And we'll see you in another video. Things are just starting to heat up here in 2023. The kangaroo market continues to represent. All right, bye for now. See ya.